No! The historical data shows the Fed will not raise rates again after today's 50 BP hike. What do we think about that? Well, stay tuned for what we talk about in this video and what we learn about what retail is up to. Keep in mind that today is the 14th. That means the coupon code PP expires for the programs on Building Your Wealth. The biggest, most popular ones right now, 0 to millionaire real estate investing. People want to learn, how do I buy my first home? How do I get my first rental property? How do I deal with contractors, finding vendors? How do I not get screwed using a real estate agent? Learn about that, all of it in the 0 to millionaire real estate investing course. And of course, the next most popular course is the brand new one, Elite Hustlers. How do I make more money during a painful time? Combined with the Stocks and Psychology of Money group, where today our trading challenge begins. Thanks so much. Check out those links down below and let's get into the video. Could this be the final rate hike from the Federal Reserve in this cycle? That is, could the very next thing the Fed does after today's 50 basis point hike be a rate cut rather than a 25 basis point hike? In this video, I'm going to share my opinion and some facts surrounding this with historical data, but we're going to start by talking retail flows. What is retail doing? I personally like looking at retail flows because oftentimes you get retail that has a very contrarian attitude, which I think is phenomenal. I think when prices go down, buying the dip is often useful, unless of course you're just on a year-long downtrend, or which we kind of have been on, or on like a 2001 3-year downtrend. It's not great then buying the dip. It's kind of painful. But retail tends to have that contrarian attitude. But interestingly, as prices go down, retail does seem to buy less stock overall. And that's exactly what we're seeing right now. I'll tell you which names are being bought more by retail right now. But at the very moment, according to a VantaTrack report released just minutes ago, we are sitting at a 20% lower than normal average of daily purchases by retail. We have an average year-to-date amount of purchases on the daily basis by retail investors of $1.2 billion. Remember, a retail investor is any individual investor. That's to be not necessarily contrasted with people on Wall Street, because if they individually trade their retail as well, it's to be contrasted with hedge funds, pension funds, institutions, or entities, right? Anyway, we've recently been sitting at about a $1 billion average, so about 20% less than average, and retail only bought 681 million of stock yesterday. Now, I say only, obviously, I mean, it's still a lot. It's still buying, according to VantaTrack. JP Morgan has been suggesting there have been some days where we might have actually been seeing retail outflows, but usually the bottom of the market is associated with this huge retail capitulation, where retail just throws in the towel, their risk tolerance is low, and they're like, we're done. One of the things that is interesting about this as well is that VantaTrack is reporting that retail tends to buy market open and close and then sell in between. Kind of interesting. We'll look at some of the positions that retail is buying as well, so we can get a little bit of an idea of what they're doing. And then we'll talk about this idea about, is this potentially the last Fed hike? That, I think, is quite fascinating to think about. All right, so let's see what we've got here for retail buying. The biggest buy the dip for retail right now is none other than Tesla. This chart here shows you price declines. On the left side, you can see price declines. And the lower they are here, the more the prices have declined. You can see Tesla's kind of been declining. Separate from the rest of the market, a lot of this likely related, likely in my opinion, unrelated to potentially slowing demand in China or potentially slowing demand in the United States, as people prefer to wait for the tax credit in 2023, which would be a tax credit they probably wouldn't actually get until 2024. Versus the $3,750 that they could get immediately if they bought in December. But either way, Tesla's had a little bit of a cycle of some potential demand concerns in coordination with a lot of concerns about potential Elon Musk selling. And retail's buying it up. I hate to say it, but I mean, yesterday during a live stream we conducted on Twitter, and Elon Musk no longer paying rent at Twitter offices, apparently and allegedly not having done so for about 3 weeks, you actually see the largest amount of selling, largest amount of volume at Tesla stock that you have seen in over a year. That's pretty phenomenal. You can see the volume chart right here is higher than at any point until we go back to November and October of 2021. So we're over a year we've hit the highest volume, leading some folks to say that Elon did a big old dumpy doodle yesterday. But hey, you know what? Retail's looking at it as a buying opportunity. I don't blame that. I actually think there is a big buying opportunity in Tesla. And I actually think one of the neat things that you could do right now is potentially tax loss harvest, move over into an actively managed ETF that has a large position in Tesla, and then that way in the future, if you rebalance, boom, well, I should say if the fund rebalances, boom, you're potentially not exposed to capital gains. Obviously, always talk to your CPA about that, but ETFs do have that sort of benefit where they can rebalance and not pass along large capital gains. I know I hear sometimes people in the comments are like, oh my gosh, but there's like a point, whatever fee, and it's like, dude, any ETF charges way less fees than what you'll pay the and the S when you rebalance and take a little bit of gains. Like, there you're paying fees of, 15 to 35 or 50% depending on what state you're in, short-term, long-term. Anyway, okay, before we get to the potential last rate for the Fed, I want to take a look at this here as well. As retail buys more of Tesla, Rivian, and Lucid combined, performance is actually going down. This chart here suggests that even though retail is buying more and the average price is going down, there must be someone selling for the price to be going down, and that is very likely institutional sellers. Institutions dumping these stocks. It doesn't surprise me. In my Tesla video, I talk about how Tesla is really an untouchable for institutions right now, because how do you defend owning Tesla, not only when it's on this downtrend, but also when you have the politics associated with it, and institutions are more exposed to political considerations for their investing purposes, I believe. I think that actually creates a fundamental opportunity for Tesla. Rivian and Lucid, I would be much more concerned about. In fact, if you search on my channel, Meet Kevin, Rivian Lucid bankruptcy, you'll learn a whole lot about these particular companies, and I think those are videos that are worth paying attention to. And look, it is worth also saying, though, it doesn't take a genius to draw some trend lines for Tesla and tell you it looks bad. It's really interesting. I actually drew this trend line probably a week ago. I think I drew this around here, more like the last week of November when we were over here. And I drew this trend line just to see where we might end up going, and we are just sitting on top of it. Unfortunately, if you just continue to extend this, if we stay within this channel, we're in a big downtrend, and it's going to take quite a bit to get a nice little breakout. And then that's just simple TA right there. I mean, this is like kindergarten level TA. But anyway, okay, so retail. What else is retail buying? And then let's talk about, could this be the last potential Fed hike? So what else is retail buying? Well, primarily it's Tesla, followed by Apple, Amazon, Nvidia, AMD. I like all of these personally, with the exception of Amazon. I think Amazon's going to be in a race to the fulfillment bottom, and you've got an AWS slowdown. Not a big fan of Netflix. Not sure how that ad model is going to go. I'd rather invest in the advertising company like a Trade Desk that does direct connected TV advertising, though they handle that for Disney and Hulu, not for Netflix. Microsoft actually handles the advertising for Netflix. So in that case, if I wanted exposure to Netflix, I'd rather be in Microsoft personally. I am a licensed financial advisor, but obviously this is not financial advice for you, because I don't know what your specific circumstances are. And then, of course, the rest here, you can kind of just look on screen and see what that retail buying is looking like. All right, so now let's go ahead and touch on this idea that maybe it's time for us to be looking at the last Federal Reserve rate hike ever, and in a massive potential U-turn. So this is an interesting one. The last, on average, I say, if you go back looking at historical data, the last Federal Reserve hike happens on average 22 weeks after peak CPI. So in other words, you hit peak CPI, on average, the last Fed hike is 22 weeks later. Well, peak CPI was 22 and a half weeks ago. And we're going to have a 50 basis point hike today. So if today was the last Fed hike for this hiking cycle, it would be in line with historic norms. And the first cut tends to happen on average 16 weeks thereafter, which would be about April, which I'm kind of projecting the first cut to be around May or June, so that roughly aligns. But I have to say, I'm not the biggest believer that even though statistically the last rate hike is 22 weeks on average after peak CPI, I'm not that optimistic that the Fed's going to stop here. Now, it's possible, and this is where things get interesting. See, between now and February 1st, you get one more CPI rate hike. Or I should say not a CPI rate hike. What is that even? You get one more CPI report, which could potentially lead to rate hikes, right? If that report comes in soft, I think the Fed's going to go for a 25 basis point hike. And we're going to hear about that today. Is it possible the Fed with just one more good CPI report could go to zero? Historically, the answer here is yes. Realistically, let's just say I wouldn't bet on it. But it is interesting. And it's something I'm going to pay attention to for when we look for clues with what Jay Powell is going to be talking to us about today. Remember, Jay Powell will be speaking at 11:30 Pacific time. We'll have the summary of economic projections and the rate hike decision at 11 a.m. I will be live for that. I can't wait to see you there. Woo, boy. Buckle up, folks. It's going to be a fun day. And, hey, you know what? Some folks are starting to say it could be time to move from short everything to long everything. Maybe that could align with, peak Fed hawkishness. It'll be interesting. Let me know what you think in the comments down below. Thanks so much. Goodbye.